Hello, you're watching Dukascopy TV. I'm Thomas Taplin. Latvia has only just joined the eurozone, but already it's experiencing a bumpy ride as it tries to shake off its murky Soviet past and persuade its citizens that the euro is the best way forward for the country. But since joining, it's already lost the lending support of JP Morgan after US regulators told the bank to tighten its money laundering safeguards. Now, Latvia's new Prime Minister has defended the country's membership, saying it's to protect itself against Russia. Well, joining me on the line is the chief economist at East Capital, Markus Svedberg. Markus, thanks for joining me today. Recently, the government said joining the euro area is basically an insurance policy against Russia. Why is the government so keen to distance itself from Russia?
Yeah, I think it's quite interesting, and I think it's a little bit of a distraction from the bigger story of Latvia joining the euro, which has, in my view, relatively little to do with Russia. But one reason why we're hearing these comments is because non-resident deposits have increased quite a lot in Latvia. There's also been a significant amount of non-residents, and this is basically financial speak for primarily when it comes to Latvia for money from the CIS and Russia in particular, and it increased most likely quite a bit after Cyprus unfolded. So the argument has been that there's been at least some Russian money looking for a new home, and that home has been Latvia, and the Latvian authorities have been trying to play down that trend.
Now, the government says joining the eurozone is the right thing, but the officials have so far failed to convince voters, with 1 in 5 opposing the euro. Around 40% of bank deposits in Latvia come from ex-Soviet states. Is it realistic for the government to believe it can turn around opinion in the nation when a quarter of its population is ethnic Russian?
Yeah, no, I think joining the eurozone is tricky to sell to a public. We've seen this, not only in Latvia but in a number of countries, and Sweden, for instance, who had a referendum, actually voted down the prospect. It makes a lot of sense from an economic and financial perspective for a small, open economy like Latvia, especially when the immediate neighbor, Estonia, is already a member, and its other immediate neighbor, Lithuania, is planning to join next year. It reduces speculation risk. It reduces the FX exposure risks, which are quite high in Latvia. It most likely will lower the sovereign borrowing costs. It will enhance financial sector stability because of they're getting access to ECB. But you're giving up your currency, which is a national symbol, and which was actually quite important in a young country, young democracy like Latvia. So I can understand that the large part of the population is against it, and they also fear that prices will be increased in the process.
Okay, let's look briefly at the recent pullout by JP Morgan. The bank's been told to tighten its money laundering policy and as a result has stopped clearing dollar transfers for Latvian lenders. This can't bode well for a nation that's just joined the euro bloc. Do you think other banks could follow suit?
I'm not sure, and I doubt this will be a bigger event. Roughly 2/3 of the banking sector in Latvia is owned by foreign banks, controlled by foreigners. The majority of these are from the Nordics, and they have shown, especially during the crisis, that they are planning to stay put. So I don't expect this to be a major event. I think it's a blip. And what we have seen over the past couple of years is a fairly dramatic deleveraging, but that is more of a result of the crisis and what happened, back in 2008, 2009, rather than Latvia joining the eurozone. I think actually, if anything, the opposite is this will increase the trust in the Latvian banking sector, and it's a logical step. They have been the currency have been pegged to the euro since 2005. This just follows a logic, and I think this will increase rather than decrease the trust in the Latvian banking sector.
Now, another Eastern European country, Lithuania, plans to enter the eurozone in 2015. Now, in total, we'll have seen Estonia, Latvia and Lithuania all join the bloc. What does this mean for the euro, and will the new banking union, if it comes into fruition, have any effect on ex-Soviet deposits being held in their banks?
I think for the euro, I think this shows that there is still a lot of traction for the sometimes embattled union. I think especially from these new, young, emerging markets, they clearly see the benefits, especially when it comes to trust, when it comes to joining the most attractive club or most prestigious club when it comes to finance and economics. So I think we will see more countries joining, perhaps not, in the next year or two, apart from Lithuania, but down the road, we might even see some of the larger Central European countries joining. When it comes to deposits, I think it's difficult to draw any general conclusions because we have seen fairly different deposit compositions in a number of countries. We're looking at Slovenia a lot lately because there's been discussion of a bailout where the non-resident deposits, for instance, look quite different, and it's different foreign banks that are active in those countries compared to the Baltic states, where the Nordic banks. So I think you have to take this on a case-by-case basis when it comes to the deposit structures.
Okay, plenty of interesting things there to digest in the coming year for Europe. Thanks for watching. I'll be back on Thursday with a look at how gold could be affected by a rising US dollar. Until next time, goodbye.